Insurance is a contract represented by a policy in which an individual or entity receives financial protection or reimbursement against losses from an insurance company. The company pools client risk to make payment more affordable for the insured. Insurance policies are used to hedge against the risk of financial losses, both big and small, that may result from damage to the insurer or her property, or from liability from a damage or injury case to a third party. There is a multitude of different types of insurance policies available, and virtually an individual or business can find an insurance company willing to insure them for a price. The most common type of personal insurance policies are auto, health, homeowner, and life. Most individuals in the United States have at least one of these types of insurance, and car insurance is required by law. Insurance is a contract policy in which an insurer indemnifies another against losses from specific categories. All There are many types of insurance policy. Life, health, homeowners, and auto are the most common forms of insurance. The core components that make most insurance policies are the deductible, policy limit by and premium. Business requires special types of insurance policies that insurance against specific type of risk faced by a particular business. For example, fast food restaurant need a policy that covers damage or injury that occurs as a result of cooking with a deep fryer. An auto dealer is not a subject of this type of risk, but does require coverage for a damage or injury that could occur during test drivers. When choosing a policy, it is important to understand how insurance works. A firm understanding of these concepts goes a long way in helping you choose the policy that best suits your need for insurance. Whole life insurance may or may not be the right type of life insurance for you. There are three components of any type of insurance: premium, policy limit, and deductible, that are crucial. Premium. A policy premium is the price typically expressed as a monthly cost. The premium is determined by the insurer based on your business risk profile, which may include creditworthiness. For example, if you own several expensive automobiles and have a history of reckless driving, you will likely pay more for an auto policy than someone with a single mid-range sedan and perfect driving record. However, different insurance may change different premium for a similar policy limit. The policy limit is the maximum amount an insurer will pay under a policy for a covered loss. Maximum may be set as a period per loss or injury, or over the life of the policy, also known as the lifetime maximum. Typically, higher limits carry higher premium. For general life insurance policy, the maximum amount the insurer will pay is referred to as the face value, which is the amount paid to the beneficiary upon the death of the insurance. The deductible is the specific amount the policyholder must pay out of pockets before the insurer pays a claim. Deductibles save a deterrent to large volume of small and insignificant claims. Deductibles can apply per policy or per claim depending on the insurance and the type of policy. Policies with the higher deductibles are typically less expensive because the high out of pocket expense generally result in few small claims. Special consideration with regards to health insurance, people who have chronic health issues or need regular medical attention should look for policies with lower deductibles. Through the annual premium is higher than a comparable policy with the higher deductible, less expensive access to medical care throughout the year may be worth to trade off. Many different types of life insurance are available to meet all sorts of need and performance depending on the short or long term need of the person to be insured. The major choice of whether the select temporary or permanent life insurance is important to consider. Term life insurance lasts a certain number of years and then ends. You choose the term when you take out the policy. Common terms 10 to 20 or 30 years. The best time life insurance policy balance affordability with long-term official strength. Permanent life insurance stays in force that insures entire life unless the policyholder stop paying the premium or suddens the policy. A typical more expensive than term whole life insurance is type of permanent life insurance that accumulates cash value. Cash value life insurance allow the policyholder to use the cash value from many purposes such as a source of loan or cash or to pay policy premium. Universal life, a type of permanent life insurance with a cash value component that earns interest. Universal life, future flexible premiums, unlike term and whole life. The premium can be adjusted over time and can be designed with a level death benefits or an increasing death benefits. Index universal is the type of universal life insurance that lets policyholder earn a fixed or equity index rate of return on the cash value component. Variable universal with a variable universal life insurance, the policyholder is allowed to invest the policy cash value in an available separate account. It also has flexible premium and can be designed with the level death benefit or an increasing death benefit.